Most traders think profitability comes from trading bigger position sizes, bigger wins, faster growth. It sounds logical. If you make money trading small, then trading big should just multiply the results. But in real trading, that logic quietly breaks down. Because the market doesn't punish bad strategies first, it punishes bad behavior. And trading big exposes behavior problems faster than anything else. That's why so many traders have the same story. They were doing fine, slow but steady. Then one day, they sized up, and everything changed. Losses felt heavier. Wins felt stressful instead of satisfying. Every candle suddenly mattered. That's not coincidence. That's position size doing what it always does, magnifying psychology. Here's the uncomfortable truth most people avoid. The smaller you trade, the more profitable you behave. Not because small trades make more money, but because they allow you to execute correctly. Let's start with something simple. When you trade small, your brain stays calm. You don't rush entries. You don't chase price. You don't move stops out of fear. You follow your plan, not because you're disciplined, but because nothing feels threatening. That calm state is where good trading decisions come from. Now compare that to trading big. When position size increases, the market becomes louder. Every tick feels personal. Every pullback feels like danger. You stop reading price objectively. You start reacting emotionally. This is where most traders think the problem is the strategy, but it's not. The strategy didn't change. The risk perception did. Let's talk math for a moment, but keep it grounded. Two traders take the same setup. Same entry, same stop, same target. One risks 0.25%. The other risks 3%. Technically, it's the same trade. Psychologically, it's not even close. The first trader can take 10 losses in a row and still function. The second trader starts panicking after 2. Why? Because the second trader is no longer trading probabilities. They're trading outcomes. And the moment you trade outcomes instead of process, profitability starts leaking. This is why small trading quietly wins. It keeps you process-focused. Most traders underestimate how fragile discipline really is. They think discipline is a personality trait, something you either have or don't. But discipline is mostly environmental. When risk is small, discipline is easy. When risk is large, discipline becomes rare. That's not weakness. That's human nature. The market is already uncertain. Adding emotional pressure on top of that is like trading with noise in your head. Now here's something most people don't realize until it's too late. Trading big doesn't just increase losses, it changes your strategy without you noticing. You start taking fewer trades, you skip valid setups, you hesitate on entries. Your system quietly becomes inconsistent. And consistency is the foundation of edge. A mediocre strategy traded consistently will outperform a great strategy traded emotionally. That's why small trading works. It protects consistency. Another reason small trading is more profitable is feedback quality. When risk is small, losses feel like information. When risk is big, losses feel like failure. That difference matters. Information leads to learning. Failure leads to fear. Small losses allow you to review trades honestly. Big losses trigger justification, denial, and revenge thinking. Most traders don't fail because they don't learn. They fail because they can't emotionally process feedback. Trading small keeps feedback clean. Let's also talk about survival. Trading is not about making money quickly. It's about staying in the game long enough for probability to work. Most accounts don't blow from one massive loss. They bleed out from emotional mistakes after sizing too big. Trading small slows everything down. It gives you time to build data, build confidence, build trust in execution. Those things compound quietly, and compounding is boring but powerful. Here's a reality most social media never shows. Professional traders don't think in terms of how much can I make. They think in terms of how little can I lose while still growing. That mindset is impossible to maintain when position size is too large. Big size forces urgency, small size allows patience, and patience is where edge lives. Another key point, trading small keeps you aligned with uncertainty. No strategy wins all the time. Losses are guaranteed. When size is small, losses are expected. When size is big, losses feel unacceptable. That emotional rejection of losses is what causes traders to move stops, add to losers, abandon plans. None of that comes from bad knowledge. It comes from overexposure. Trading small respects uncertainty. Trading big fights it. And the market always wins that fight. Now let's talk about confidence. Real confidence, not hype confidence, not screenshot confidence. Real confidence comes from repetition. Hundreds of trades, same rules, same execution. That only happens when risk is small enough to tolerate repetition. If every trade feels like it matters too much, you won't repeat it enough to master it. Small trading builds skill. Big trading tests ego. Most traders reverse that order and pay for it. This is why traders who size down often start making money again, not because their edge suddenly appeared, but because their behavior came back. They stopped forcing, they stopped reacting, they started executing, and execution is where profitability actually lives. In the next part, we'll go deeper into why traders feel pressure to trade big, the illusion of fast growth, and how small size creates smoother equity curves over time. There's a reason traders feel constant pressure to trade big. It doesn't come from the market, it comes from comparison. Most traders don't wake up wanting to risk more, they wake up wanting to catch up. They see screenshots, they hear numbers, they watch people talk about flipping accounts in weeks, and slowly, quietly, patience starts to feel like failure. That's how trading big sneaks in, not as a strategy decision, but as an emotional response. The illusion of fast growth is one of the most dangerous things in trading, because it's not completely false. Yes, trading big can grow an account faster, but only if execution stays perfect. And perfect execution under pressure is extremely rare. What usually happens is this. The first big win feels incredible. It confirms the decision to size up. Confidence spikes. Then comes the first big loss. And suddenly the trader is no longer trading the market, they're trading their last outcome. After a big loss, traders don't just lose money, they lose neutrality. They start trying to fix things immediately. They trade earlier, they trade more aggressively, they skip confirmation. This is where the math starts to break. A strategy that expects a certain win rate and loss size no longer behaves the same once emotions interfere. Trading small protects the math by protecting the behavior. Now let's talk about equity curves. Most traders imagine growth as a smooth upward line. In reality, equity curves move in waves. The goal is not to eliminate drawdowns, the goal is to control them. Small position sizes create shallow drawdowns. Shallow drawdowns are easier to recover from, both financially and emotionally. Big position sizes create deep drawdowns. Deep drawdowns require extraordinary discipline to recover from. Most traders underestimate how hard recovery actually is. A 10% drawdown feels uncomfortable. A 30% drawdown feels personal. A 50% drawdown feels impossible. The larger the drawdown, the more pressure there is to do something irrational. That's why small trading quietly outperforms. It keeps drawdowns in a range where logic still works. Another overlooked benefit of trading small is decision quality during uncertainty. Markets are not always clear. Sometimes conditions are messy. Sometimes setups are not textbook. When trading big, uncertainty feels dangerous, so traders either avoid trades completely or force certainty where none exists. When trading small, uncertainty is tolerable. You can take marginal trades. You can experiment. You can learn. That learning phase is where real edges are discovered. Most traders never reach that phase because they emotionally bankrupt themselves first. Let's also talk about expectations. Trading big creates unrealistic expectations per trade. Every trade starts carrying weight. Every loss feels like a setback. Every win feels like relief instead of progress. That emotional roller coaster is exhausting. Trading small lowers emotional expectations. A single trade doesn't matter as much. A loss is just part of the sample. A win is just execution. This mental shift is subtle but powerful. It turns trading from gambling into repetition, and repetition is how probability works. There's also something important about time. Most traders think they don't have enough time, so they try to compress results. But markets reward those who give time, not rush it. Small trading stretches time. It allows traders to stay active without burning out. It allows them to survive periods of poor performance. It allows improvement to happen naturally. Big trading compresses time. It forces urgency. It forces decisions before readiness. It forces growth before stability. And growth without stability always collapses. Another key point is adaptability. Markets change, conditions shift. When trading small, adapting is easy. Mistakes are cheap, adjustments are manageable. When trading big, adapting is painful. Every change feels risky. Every mistake feels costly. So traders freeze. They keep trading outdated rules because change feels too dangerous. Small size keeps flexibility alive. Now let's talk about something most traders don't admit. Trading big often feeds ego more than performance. It feels serious. It feels professional. It feels like progress. But feeling like a trader is not the same as being profitable. Small trading is boring. It doesn't impress anyone. It doesn't produce dramatic stories. But it produces accounts that last. And longevity is the real edge. Most traders who eventually become consistently profitable all say the same thing. They didn't make more money by finding a better strategy. They made more money by reducing pressure. And the fastest way to reduce pressure is to reduce size. In the final part, we'll talk about when trading bigger actually makes sense, how to scale size correctly, and how small trading builds accounts that can eventually handle bigger risk. At some point, every trader asks the same question. If trading small is so good, when do you trade bigger? That's the right question, because the goal is not to stay small forever. The goal is to earn the right to scale. And most traders get this part wrong. They think scaling is a reward for confidence, but scaling is actually a consequence of stability. You don't size up because you feel ready. You size up because your results have already proven it. Let's talk about what that actually looks like. A trader who is ready to increase size doesn't feel excited about it. They feel almost indifferent. That's important. If the idea of trading bigger makes your heart rate go up, you're not ready. Because bigger size should not change how you trade, only how much you earn per unit of execution. Most traders scale too early because they confuse confidence with competence. Confidence can be emotional. Competence is statistical. Competence comes from hundreds of trades, consistent execution, predictable drawdowns, and stable equity growth. When those things are present, scaling becomes boring. And boring is exactly what you want. Another critical mistake traders make is scaling all at once. They go from risking 0.5% straight to 3%. That jump is massive psychologically. Even if the math still works, the trader usually doesn't. Proper scaling is gradual. You don't double size, you increase it slightly and observe behavior. Not performance, behavior. Do you still follow rules? Do you still take losses cleanly? Do you still wait for setups? Do you still stop trading when conditions are bad? If behavior changes, size is too big. This is where trading small shows its real power. It teaches you how you behave under control. That behavior becomes your baseline. Scaling only works when that baseline remains intact. Here's another uncomfortable truth. Many traders don't actually want profitability. They want excitement with the possibility of profit. Trading small removes excitement. It exposes intent. If trading small feels pointless, then the goal was never consistency, it was stimulation. Markets don't reward stimulation seekers. They reward process followers. That's why traders who learn to be profitable trading small often stay profitable when they scale, and traders who skip that stage usually don't last. Let's talk about longevity. Trading is not a sprint. It's not even a marathon. It's closer to a lifestyle. And lifestyles are built on sustainability. Small trading builds habits that scale naturally: risk awareness, emotional control, patience, acceptance of losses. Big trading without those habits builds stress. Stress doesn't show up immediately. It builds quietly. Then one day, a normal losing streak feels unbearable, and that's usually the day accounts break. Another reason small trading is more profitable is that it allows traders to stay objective. Objectivity disappears under pressure. When size is too large, traders start defending positions. They argue with the market. They justify bad trades. When size is small, the market stays neutral. You can admit mistakes, you can exit cleanly, you can move on. That neutrality is priceless. Now here's the part most people don't want to hear. The market doesn't care how fast you grow. It only cares whether you survive. Fast growth followed by collapse is common. Slow growth followed by consistency is rare. And rarity is where real profits live. Trading small feels like delay, but it's actually preparation. Preparation for larger size. Preparation for longer careers. Preparation for inevitable drawdowns. Traders who accept this tend to last. Those who don't usually burn out. So when people say, "I'm not making enough trading small," what they're really saying is, "I'm impatient with probability." Probability needs volume. Volume needs repetition. Repetition needs tolerance for boredom. Small trading creates that environment. Big trading destroys it before it forms. In the end, trading small isn't about fear. It's about respect. Respect for uncertainty, respect for psychology, respect for the fact that the market will always be unpredictable. Those who respect it survive. Those who rush it usually don't. That's why trading small is often more profitable than trading big, not because it makes more per trade, but because it allows traders to keep trading, and staying in the game is the only way profits ever compound. There's one more layer to trading small that most people never think about. It's not about money at all. It's about identity. When traders size up too early, they don't just change risk, they change how they see themselves. They start thinking, "I'm a serious trader now." And that thought is dangerous. Because the moment identity gets involved, mistakes become personal. A losing trade is no longer just a loss. It feels like proof that you don't belong here. That's when traders stop being honest with themselves. They hide losses. They avoid journaling. They stop reviewing trades objectively. Not because they don't want to improve, but because improvement would require admitting discomfort. Trading small protects honesty. It keeps your ego out of the equation. You're not trying to prove anything. You're just executing. That mental state is rare and powerful. Another overlooked advantage of trading small is decision fatigue. When risk is high, every decision drains energy. Should I enter now? Should I wait? Should I exit early? By the end of the session, the trader is exhausted. Exhausted traders don't trade well. Trading small reduces emotional load. Decisions feel lighter. Energy lasts longer. That's how traders stay consistent across weeks and months, not by pushing harder, but by needing less effort to stay disciplined. There's also the issue of time distortion. When trading big, time slows down. 5 minutes in a trade feels like an hour. One loss feels like a day ruined. That time distortion leads to impatience. Traders start forcing activity just to escape the discomfort of waiting. Trading small normalizes time. Trades take as long as they take. Waiting feels neutral instead of painful. And waiting is where most profits are actually made. Now let's talk about something almost nobody talks about: regret. Regret doesn't come from losing trades, it comes from knowing you didn't follow your plan. Most regret in trading is self-inflicted, and regret builds fastest when position size is too big. You replay decisions, you question every choice, you carry losses into the next trade. Trading small minimizes regret because mistakes are survivable. You can say, "That wasn't perfect, I'll fix it," instead of, "That mistake just cost me weeks." That difference keeps traders mentally stable, and mental stability is the most underrated edge in trading. Another thing trading small does well is it reveals your true edge. When risk is low, luck fades faster. You can't rely on 1 or 2 wins, you need repeatability. That forces clarity. You learn what actually works, not what feels exciting. Many traders think they have an edge when they're just riding volatility with size. When they reduce size, the illusion disappears. And that's a gift, because now you can build something real. Finally, trading small aligns you with reality. Markets are uncertain. Outcomes are random in the short term. Control is limited. Trading big fights that reality. Trading small accepts it. Acceptance doesn't mean weakness, it means efficiency. The most profitable traders aren't trying to dominate the market, they're cooperating with probability. And probability only works for those who stay long enough. So when someone asks, why trade small, the real answer is simple. Because trading small allows you to stay honest, stay patient, stay consistent, and stay in the game. And staying in the game is the only way profits ever become permanent.